Well, markets are set to close high today after the Fed Reserve cut bond purchases by another $10 billion as expected, and investors seemed happy to shrug off a dreadful result for first quarter GDP. Now we're joined by Keith Bliss. Keith, the Fed mentioned that economic momentum was picking up, but to what extent do you think that expectations for better economic data may be too high?
Well, it's a tough question to answer. I mean, some of the economic data that we've gotten over the last 2 weeks has actually been mixed. The housing numbers seem to have stalled out a little bit, both new home sales and existing home sales, but yet we're starting to see a pickup in manufacturing in this country. So the real important number on the economic data, I feel, will be tomorrow when we get a look at personal income and outlays. So that's one of those numbers that the news services, the media tends not to pay attention to, but those of us who are in the market, we really look at, because what that tells us is how much people are earning and how much they're spending. And in an economy like the U.S., where 70% of it is consumerism, that is the all-important number. Manufacturing, of course, supports that because that tells us how many jobs are being created to a certain extent, how much activity is going on, what do the productivity and capacity utilization numbers look like. It's an amalgamation of economic data points that we try to look at to gauge this. So at this point, given what we've seen, I would have to say no, the expectations are not too high. The FOMC was comfortable enough with their statement today that they are blaming the first quarter on the weather. They as much said that by paring back $10 billion. If they thought that there was something more fundamentally going on inside of the economy which led to that 0.1% GDP growth in the first quarter, they would have made a different statement. They didn't make a statement. They seem to think everything's on track. They pared it back by $10 billion. At the current pace, they should be out of the market on new purchases by the end of this year. So I have to take them at face value. But again, look at the personal income and outlays number tomorrow to see if what they say is accurate.
Okay. Now, earnings are beating expectations so far, but then again, expectations are pretty low. What's your assessment of how it's progressing?
Well, I think more than just beating the street expectations and what the Wall Street analysts are saying, there's a couple of things going on. They're not only beating on EPS and revenues, but we're also starting to see a positive growth rate for this quarter. The S&P 500 sector in total was supposed to be negative earnings growth this quarter, and it's turning out to be positive. So despite what they're doing against the analyst expectations, just the mere fact that they're still selling more things and they're still earning more on the things that they're selling is a positive note. And I think that's what's giving a lift to the stocks. I don't think any company, not any company, but most companies that have reported so far are thrilled with their quarter, with their first quarter. They wish that they could have higher growth rates, but anything that comes in positive on a growth rate, both EPS and revenues, top-line revenues, will take, and that's what's lifting the market.
And just briefly back to the Fed, after the announcement we saw markets turn higher, they moved lower, and now we're set to close higher. Do you interpret that as investors simply saying this is what we expected?
Yes and no. There's two things going on here. Expect the markets to be sloppy throughout 2014. I mean, despite we've got 5 more FOMC meetings and announcements, so I expect the market to be sloppy around those times, but it'll be choppy and sloppy at other times too. And the other thing that's really going on in the market that people need to realize, right here, you and I standing right now, we're less than 1% away from the all-time highs in the Dow and the S&P 500. Pretty remarkable when you think back at the beginning of the March, we thought the 10% correction was upon us. So that's also going to lead to some choppiness and some lack of direction inside of the market. I wouldn't blame it all on the Fed statements or what they're saying. It just happens to be coincidental to today. People need to get used to the fact that despite volatility coming in a little bit because the markets have rallied for whatever reason, it's going to be a bumpy ride throughout 2014. Opportunities to make a lot of money, but I'm not sure we're going to see any breakout to the upside, or we might see a 10% correction sometime this year, but I don't think it's anything to get worried about. I suspect we'll be in a pretty tight range all year.
All right, thank you, Keith. That was Keith Bliss of Catone, and I'm Jane Searle for The Street.